Unhappy, disgusted, and plain depressing. Those are just a few adjectives one can use to describe what is arguably the most challenging housing market in decades. From California to New York and everywhere in between, the American dream is dying in front of our eyes. The housing market, a once stable entity, has turned into a violent and volatile marketplace resembling a casino. Greedy investors, massive prop techs, home builders, and flippers dominate this new landscape. The single-family home has turned into a tulip, and with each passing day, the price you previously believed to be unsustainable is shattered. The common belief is simple: the bubble has to pop, and the number one reason is sitting right in front of our eyes. It's something everyone can see and feel, and to explain it, we look no further than this chart. Homebuyer debt-to-income ratios are now approaching 40%, a situation we have not seen for decades, showcasing the biggest red flag in the market, which is affordability. In fact, according to this viral tweet by Nick Gorelli, the ratio has now exceeded the highs we witnessed in 08. The last time the ratio got to this level, the US went through its worst housing crash since the Great Depression. Now, even more concerning beyond this fact is that despite these high debt-to-income ratios, people are putting down less money than what we saw prior to the 08 crash. Today, the average person puts down around 18% on a typical mortgage, about 3% less than prior to the last crash. So, homebuyers are putting down less, using up more, and taking on similar interest burdens in 2023 compared to 2006, and everyone is expected to believe that this market is totally normal and not in the middle of a massive bubble. Think about this for a second. Just a few years ago, going back to 2019, a new buyer in the United States could expect to pay around $1,300 a month for an average home. Now, as the years went on, we witnessed a spectacular rise in prices, which obviously elevated the typical payment to levels we never thought were going to be possible, but the pain did not stop there. On top of these massive jumps in price, we had massive jumps in interest rates. Today, following the damage that this double-edged sword inflicted on the market, a typical homebuyer can expect to pay $2,600 a month for an average home in the US. This is quite literally a 100% increase, so it could be argued that in just 4 quick years, the price of a home in relative terms for a normal everyday buyer using a mortgage doubled. If that's not a bubble, then I don't know what is, and as we continue to see prices jump, everyone is wondering when the madness will stop and how this bubble will eventually pop. But before I answer, please take a moment to hit that like and subscribe button if you're enjoying the video thus far. Each like is fuel for the algorithm, and I would appreciate it if you just took 2 seconds to click the button. Now, to answer that question, we have to take an alternative approach. The answer may not be what you think. You see, as much as it pains me to say this, we all may just be wrong. Sure, the YouTube algorithm and even you guys watching this video love to hear about the next phase of the crash, but there's a very good chance that for the foreseeable future, this welcomed relief in pricing isn't going to happen. All of these videos we see on YouTube and all of the threads you read on Twitter have one thing in common. They take data and shove it into whatever thesis they're trying to present in a way to make it appear as if they are correct. If you want to see what I mean, just take a look at the first chart we mentioned. Sure, it is true that debt-to-income is increasing. There is no doubt that this should be a concerning development when you look at a chart like this, but look a bit further and you find the ugly truth. The fact is, most people that are paying a mortgage today are paying one with an interest rate that is lower than 6%. If you take a look at all the mortgages in the US, you'll see that specifically 91% of people are paying less than 6, and what's even more surprising is that 25% are paying less than 3. The truth about this chart is that it represents new buyers with fresh new mortgages, and as you may have heard, the number of homes sold has been plummeting for years now. There are very few new buyers. Which means that while these people taking on these new high interest, high debt loans is concerning, they are such a small cohort that their addition to this massive mortgage bucket of sorts has very little impact to the overall pie. According to the National Association of Realtors, the number of homes sold in the country is 40% less today than what it was during the peak in the summer of 2006. So with so few transactions, it's going to take years, potentially decades, to grow this cohort of people who are paying mortgages with serious debt and high rates. And this doesn't even begin to take into account the fact that around 40% of all homes are owned outright. That is, that the occupants or owners are not paying a mortgage. Simply put, the story is obvious. This chart, along with many others like it, are a misrepresentation. The truth is, yes, homes are expensive and interest rates are high, but there is absolutely no indication that we're going to get a wave of bankruptcies that rattle the market, at least not for the next couple of years, barring a wild surprise shock to the economy. If you don't believe me, look no further than this. If we look at the percentage of mortgages that are 30 to 90 days delinquent, you can see that since the '08 crash, this number has been coming down. Today it sits at 1.4%, which is well below that pre-2020 average, showcasing that foreclosures make up a tiny percentage of the market today. Some will argue that year-over-year increases have been significant and that this slight bump from the 2021 lows is clear evidence that we are headed towards disaster, but that is yet another instance of fear-mongering. We know that following the great health crisis of 2020, bankruptcies were essentially stopped and were put on pause. So of course, the uptick following that year was going to look significant, but this is just a matter of base effects. The numbers were so low that year following the pause that any normal number was going to look like a huge increase when looked at through the scope of this small time frame. Zoom out and you get a different story. Today, delinquency rates are near record lows, historically speaking, far lower than even the 2019 numbers, and it just goes to show you that buyers are still relatively healthy. The financial stress is seemingly low. Throughout the United States, prices are once again stable, even increasing. If you want evidence of this, look no further than the epicenter of the supposed crises, Austin, Texas. Here in 2022, prices started to plummet and this town was labeled the center of the crash. From May 2022 to February 2023, prices dropped 23%. A true panic had started, but look at more recent numbers and you start to see that this was just a big head fake induced by a rapid increase in mortgage rates. Since that low point, prices have risen 15% and are now just 12% off the all-time highs. Everywhere you look, you see this similar pattern emerge. Prices are headed up, not down, and for the foreseeable future, this isn't likely changing. The promised crash is on hold once again, and we are going to need a serious crisis to change the path of this market. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and if you're facing difficulty finding a home, please consider heading over to foreclosure.com with the link in the description. Foreclosure.com can help you find some of the best deals available today by targeting distressed properties such as bank-owned homes, government foreclosures, pre-foreclosure listings, and foreclosure auctions. Whether you're looking for a single-family home, condo, townhouse, or mobile home near you, Foreclosure.com provides the most up-to-date listings of all property types. Please check out the link below.